So, welcome everybody to the fourth webinar episode of the ETN Global webinar series on the profitability of thermal assets. Today, we have the pleasure of having our member, HY8PC from the Netherlands. Together with their representatives, Ilya and Robert, will go through the dynamics of current power markets and how these are changing with the increased needs of flexibility, given also the increased share of variable renewable energies. And also, all of us will familiarize a bit more with the new schemes that are part of the evolving power markets. So with this and no further delays, I'd like to give the floor to Ilya and Rob. And on behalf of ETN, I would like to thank you for your availability and time for this webinar today. Thank you.
Thanks, Nicola. Thanks. Okay, let us start. My name is hello everyone. My name is Ilya, and Robert de Kler is my colleague. We will speak about how power markets are changing recently due to rising share of renewable energy, due to other factors as well, and what it means for thermal assets and specifically for gas turbines. We have a little bit of introduction and then maybe 40-45 minutes of a presentation. And then at the end, we can have 10-15 minutes for Q&A. I will start from with introduction. My name is Ilya Bilibin. We are from HY8PC. It's a Dutch equipment manufacturing and power producing company. And we make innovative design of gas turbines. But my background is in power markets. I started in power exchange in Russia, focusing on capacity market actually, and less on wholesale electricity market. And then I worked in consulting companies with Kima or DNVGL, and later with McKinsey. But last years, I'm a project developer for renewable energy projects, and Robert is my colleague.
Yes, so my name is Robert de Kler, so I'm also involved with HY8PC. I have a background in the power industry with my early years at Kima, now called DNV. I was doing there all kinds of system modeling and optimization of power plants. So I have run a portfolio at Nuon, now called Vattenfall, and we sold the power portfolio. I went and developed my own technologies and pathways as an independent consultant.
Okay, we will go to the main topic of our presentation, and overall message that I want to convey today is that thermal assets, their revenue does not come from sort of amount of megawatts when they produce, but their revenue comes from megawatts that produce at the right time. That dispatch of energy and revenue are decoupled, and the timing of the assets which products you sell is actually what determines the value of the assets today. So very shortly, going to the main topic of our presentation, I want to start with a little bit of history, how power markets were designed, what was the reason behind it, and why they stopped working in the way they were supposed to do, and then what it means for dispatch and valuation of thermal assets. So power markets, the idea behind it was to, or the economic theory behind power markets was to design a single liquid market where pricing is marginal, is based on a marginal principle. And the economic theory behind it, the economic theory goes that is if pricing is determined by a marginal producer, so the least efficient producer, then it gives an incentive to power producers to become more efficient, to invest, build new power plants, become more efficient, and when power producers, they can earn money from the margin between their bid price, the price with which they bid to power market, and the power price that sets in the market. And then as more and more producers compete, then average price would also decline for a consumer. So that was a theory, but this theory assumes a lot of things, assumes that power producers, they bid fairly, that bid price reflects their price, that there is no market games, but there is one single liquid market, and then also critically that it is liquid because there is abundant amount of flexible energy. And the situation where we are finding ourselves today is that there is a more and more amount of solar and wind energy that penetrates power market, and that energy pushes power markets outside of their design assumptions. And then I want to show specifically what is the mechanics behind this push, and also then why power prices no longer reflect energy scarcity. So I think we all discussed in the seminars that there is increasing amount of solar and wind energy, and this energy is volatile and predictable. And what it leads most concretely, it leads to breaking day-ahead optimization. So idea of a day-ahead optimization is that for thermal power plants, for less maneuverable power plants, you can have predictability for 1 day ahead. You can plan how much energy you want to produce at what cost, and power market settles it and makes this decision concrete. But because of unpredictable nature of solar and wind energy, actual amount of energy that is produced and consumed deviates more and more from the day-ahead optimization. And that, in fact, it breaks day-ahead optimization. And we see it here. I show an example from TenneT, the Dutch grid operator, but it manifests in increasing amount of imbalance energy, and also that imbalance prices are rising. And even, for example, on the second image, you see that short-term imbalance prices were more expensive now than long-term imbalance prices, which wasn't the situation even last year or a couple of years ago. What else you see is that I think that's on the mind of many people, if you read the news now, is that there is an increasing amount of negative prices, which squeezes their revenue that owners of thermal assets, but also owners of renewable assets can receive. And in parallel with that, there is also an increasing amount of peak and power prices, and that reshapes power markets. And this, what it means for power price, it means that power price as an economic signal, as economic theory goes, doesn't represent the scarcity of energy anymore. It represents, in fact, scarcity of flexible energy. So energy that can be dispatched at the right time. Beyond that, there are effects that also break assumptions behind power markets. So there is increasing amount of redispatch. Also, example that everyone knows is German power grid, where in the north there is too much cheap wind energy, and consumption is more concentrated on the south, but the grid cannot deliver that energy to the south. So you have different loop flows. You have also redispatch where German grid operator switches off, curtails power plants in the north, and then switches power plants in the south, which need to be compensated, and this all happens outside of power market. Man, what it means for owner of or dispatcher of a power asset is that dispatch and revenue are not are decoupled. In fact, that amount of mega, or let's say before, their revenue that you received was proportional to how much megawatts hours of energy you produce, and this link is broken now. So it's more the timing of when you produce becomes more and more important becomes more important rather than amount of energy that you produce. And I think what it means in terms of power market design, it means that we enter in a reality where we have different markets for different products and even off-market mechanisms. And some of these mechanisms, they determine when you produce what amount of energy, and other mechanisms, other markets, they determine when you receive revenue. So let's say here I call it physical reality. These are mechanisms that try to solve when you have to produce energy. They try to optimize, they try to match supply and demand, they try to match that grid, they try to make sure that grid is reliable, that grid constraints are met, that forecasting errors can be connected. And this is sort of traditional power markets. It's a day-ahead market, it's balancing market, it's markets for ancillary services. But outside of this realm, there is sort of what I call financial reality. But what I mean by that is that there are other mechanisms that determine that energy that you produce remains profitable. And this is a mechanism like power purchase agreements, it's contracts for difference, it's capacity mechanism, difference futures and hedging strategies, etc. And these two realms, they are in fact decoupled. So then what does it mean? How do you dispatch your asset in this situation where you have different mechanisms? I think one, or let's say the let's say first step that you have to consider is that you have to operate across all power markets. It was happening before, but you have to consider and allocate capacity between different power markets, but that becomes more and more important. So in your dispatch decision, you should allocate capacity for day-ahead market, you should allocate capacity for balancing market, but also for all other mechanisms. So if you contract capacity off market, etc., and you have to your optimization strategy, your dispatching algorithms should be able to allocate capacity across all of power markets, and each market represents a product. So your dispatch optimization should must consider now all of the products that you're producing, and then correctly dedicate capacity for each of the products that you produce. So there is very different markets which you consider. In each market represents a different product, and then you should in your optimization strategy you must consider all the products, let's say all use cases for your assets, all revenue streams for your assets. So for example, if you example that is shown here is, for example, if you are, for example, a gas turbine operator and you have a contract with a data center, you supply and provide a data center, but maybe you're not using all of your capacity for supplying data center, and then you can also provide services to the grid, balancing services, start different kind of reserves, and that you should be able to consider all use cases for your asset in your optimization. So so in this new market reality, you should consider all the products that you produce in all the markets. Rather than intervene.
No.
Yeah, so you should consider all the products you produce in all the markets. And man, for each products, how do you actually dispatch your asset? And traditionally, you were looking at let's say this was done by day-ahead optimization or market optimization, but now you should look dynamically in real time. You should look at a spread of your, let's say, contract with the market and the actual price on the market, and you should dynamically in real time decide, or let's say, re-optimize your dispatch. So, for example, you have contracted to produce electricity at a certain price, and now power price at the market is lower. It could be, or let's say, lower than your production cost. It could be more profitable for you to switch off your assets and buy power from market and sell it back to the market. But it's not possible anymore to dispatch your asset for a day and then leave it there and then just produce according to the schedule. You can earn much more money by rechecking your optimization every as it happens, and dynamically dispatch your asset. So now looking at how you dispatch your asset, what does it mean for valuation of your asset? I think message is that when looking at valuation of your asset, you should look at all the use cases which you can consider, which products you sell, at what markets you sell, and all this represents a revenue stream, which should consider evaluation, and also you should consider how you realize that revenue stream. So how do you dispatch? What is your dispatch mechanism? Is it day-ahead optimization? Is it dynamic optimization? What is the timing of your dispatch? And what it also means is that if you rely on more traditional methods of dispatch, if you look simply at LCE price, or if you look at future base, that probably underrepresents or misrepresents the value of our assets. And you should, when evaluating the value of gas turbine, for example, this method's probably not the best way to assess the value of a gas turbine. And that was more general theory, what's happening in the power market in general. What it means for gas turbine. Is it a long-term opportunity? Is it, let's say, what can happen with gas turbine? I think our assessment is that gas turbines they operate in a unique spot in this market, and that's a long-term opportunity for gas turbine, and they will remain. But gas turbines, they provide a specific service to the market, so they they don't compete exactly with our flexibility providers like battery storages, for example, but they complete and complement those providers, because gas turbines, they can focus on sources of scarcity that batteries cannot cover. So they specifically gas turbines, they can provide, they can solve issues of they can provide flexible energy during longer periods when battery is good. They can provide some physical services, like they can provide inertia, other reserves like black start capability to the grid, which batteries can provide to extent, but not fully. They can generate synthetic inertia, for example, but this is not enough for operation of a gas turbine. And then also in, let's say, in security of energy, or in the content of security of supply, etc., gas turbines, they can provide fuel optionality to your market. They can burn different fuels. The gas turbines can withstand Dunkel flow to extreme events, and yeah, they can support the grid. So gas turbines, they provide a unique service to the grid. They operate in a unique spot, which is not covered by traditional flexibility providers. And in our opinion, this is a long-term opportunity for gas turbines. I think I was rushing a bit from my presentation.
Yeah, it's quite rushy, but I think especially on the opportunity of gas turbines, it's mainly focusing on the imbalance market, or let's say if you want to do support a certain industrial player who wants to have baseload power or certain guaranteed availability of electricity, then the price mechanism should be different. So you don't pay for the say forward marginal cost price and then typical future prices you can make with all kinds of tooling. Now you have to look into the actual price. What is the real cost of having let's say your base load while the whole system is increasingly uncertain? And so then you have the question, what is the actual cost of flexibility and how can you price that into your product? And that's why, and then how can gas turbine benefit from it? And of course, batteries is always for the short term a good solution, but for longer term, more than 4 hours, then yeah, your charge state of your battery is most likely empty, or it's just too expensive to use batteries. So then you have more or less dispatchable power based on maybe hydrogen or based on natural gas or LNG, or something like an availability of a fuel which is available for a longer period, and that is I think a price attached to it, and we have to accept this higher price for flexibility, a green, clean, or sustainable flexibility, and the cost of that, that's I think also underestimated. And I think that's also more or less what is hidden between this behind this whole presentation, that we have a different situation, different mechanisms, and it requires also different ways of evaluate projects. And while data centers goes for high availability, so they are accepting and have a willingness to pay. But I think in a more generic term, if the whole grid of a country or a certain domain or industrial cluster also require a certain guaranteed offtake, or say offtake and supply, so demand supply, yeah, then there is a cost to it, especially when we want to increase the amount of renewables into the system. And that is, I think, the crucial element. And how to price it, how get, I think, an adequate support for this, subject to how you, from country to country can be different. But I think at least, as you saw in Germany, there's a lot of negative, a large volume of negative prices. That gives also the opportunity to benefit from it. And another side, that means that there's also an enormous volume of high prices. So I think that's more or less what, and that gives you opportunity for a gas turbine to play in that market.
Yeah, maybe when Nicola, we can have Q&A, we can have a discussion, because I think I thought it would take me 40 minutes, but I was rushing a bit. Maybe let's do Q&A and have more of a discussion. Yeah.
Yes, absolutely. So thank you, Ilya, and thank you, Robert, for your presentation. So we'd like to open now the floor for any questions or comments you may have on the content from today's presentation. Either you can unmute yourself or you can also write your question or comment in the chat of Microsoft Teams.
Oh, questions?
No questions?
So we still have a bit of time. Yes, so we have a message by Martin NK from DLR, our member. How does the compensation work for inertia? Is there a common EU market?
No, there is a coupled market for energy, but for grid services, it's country based. It depends on each grid operator decides how much inertia we need, how it should be compensated. There is some directions, European directions, to try to harmonize it, but it's not a single market yet.
No, although we are on a one copper plate, so if system inertia plays a role for all Europe, for instance, so if we have a frequency drop somewhere in, let's say, in Italy, then of course the whole system will follow. But that means that you have over-the-counter imbalances, and that will be solved mainly by we call static, of course, the primary control layer, which is reducing significantly if we reduce the asset base. So inertia needs to be restalled. There's a role for batteries, so to say, but that will be limited because they cannot run for. They can be empty, and then you don't have system inertia anymore. You can maybe have some demand-side response from electrolyzers, which can also offer this type of services, but also that will be questionable because you need something like a rotating equipment which can be dispatched like we had always with the static, or we call that primary control. But inertia is an important thing, and it needs to be harmonized, I think, especially when you look at it from a European perspective.
So, another question. Thank you. Good afternoon, Ilya and Robert. My question is on the technical requirement for a gas turbine, right? So, if you now look to flexibility, it means that you have a lot of ramping up and ramping down. So my question is basically on, is there any grid code which provides you guidance what can be the ramp rate of your machine? So should it be 5 megawatt per minute or 5% or 10% of the maximum capacity, or what is it? Do you know that?
Yeah, there's a grid code, so you need to follow this grid. That's more or less agreed, certain amount of megawatts. I don't have the percentages of it in my mind because maybe it changes, so I don't want to risk that part. But there's a agreed way of ramping up rates and ramping down. Although you can think about if you increase the amount of renewables with more swift responses, that you need much more capacity to ramp up, ramp down than you need in the past. So the ramp rates will be increasing while maybe the amount, maybe what you need actually on firm basis may be lower. So, but that is just because of the speed, and I think that is also important that batteries in combination with sort of hybrid solutions could play a role here, like batteries for the swift response, and that you have there quick response, but then and on the longer time frame you can ramp up your gas turbines. So yeah, there might be some hybrid solutions to really meet that goal. And I think it's also important to understand that if there is something like an imbalance or a secondary thing where you play on the imbalance market, it's very important to capture that value when you have to ramp up, that you are there. So it will be of also your own let's say you will benefit from an let's say tripless quick ramp up, and tripless quick it doesn't work always together. So I know from my experience that you have you better have that you, if you ramp up, that you really ramp up and don't have a trip, because that can maybe cost you much more money. But of course, the ramp rates, that will be an important tool for value, and that can really help to cover and maybe utilize more out of the power market, especially when imbalance market.
When I looked, I was looking at the German market, I think 50 hertz area, and in frequency restoration reserve markets, there is a document that specifies how you can access to the market, and then there is a physical characteristics which you need to be able to guarantee. So it also includes ramp rates. I also don't remember by heart the percentages, but yeah, there is a document that specifies how you can access this market.
Normally, the gas turbines can easily, as a combined cycle, can easily follow those ramp rates. That's not so then the whole capacity can be then, let's say, ramped up within 1 hour.
Yeah,
so that's
clear.
more or less what you see.
So my point is, my question basically is when you have less capacity running, and that's exactly what you say, Robert, you need higher ramp rates, right? To basically overcome the instability. So my question is it the gas turbine which is could be the limiting factor, or is it the network which could be the limiting factor, or is it both?
Yeah, I think that's a good point, because that is also the infrastructure around it. If you need higher ramp rates and you have a limitation or constraint on your network, then you cannot offer that service because you have limitation on the grid capacity part. So that's a major issue as well. So you can install, let's say, a bazooka, but if you don't have enough capacity, you don't have the facilities to use it, to transfer this power to somewhere else, that is a problem. That is what I try to say also over the counter, so that's also limited. So we try to solve that with the imbalance market over the countries, but that's also limited. Although the network organizations have more or less maybe make all the capacity available for that functionality, although you still can do some over-the-counter trading, to my opinion, I know, but also that is limited just because of that and system inertia.
Okay, thanks.
Christian, hello, please go ahead.
Yeah, Christian from Aachen University. First of all, thanks for your talk. You stated that traditional measures like LCOE are not really suited for the new energy markets, which I totally agree. Do you already see new measures evolving which are both practical and also still comprehensive?
Yeah, I think that's a good point. You can think about cost abatement curves, and you think about reduction of CO2 or whatever, or green power as a cost abatement, and then you take in consideration, the flexibility capabilities, the performance, and that against which efficiency and then price levels that could work. So then you have much better understanding what we are looking at. If you make a map order of means of flexibility, of clean flexibility. That's maybe a way forward, I would say, but that's really academical talking now. But that's what you see, that you look at the abatement curves, cost curves. But then not only looking at efficiencies, but also at performance, ramp rates, as you name it, and part load efficiencies, all the emissions related to the part load conditions as well. That's important because it shows a little bit the operating window, how flexible, and but then you have of course still something like a marginal cost element in there, but you look at but then you also look at how quick can you be in the market, how can you benefit, at which cost levels you can participate. That's I think more a way forward. Maybe that's just thinking loudly, but that could be a way forward. We think that is what you see now in the Netherlands. We are looking at the cost of flexible power and do more research in this field.
And as a project developer, how I would evaluate value of the asset is by looking at use cases and stacking use cases top of each other. So, for example, if you have a battery, you would earn some money from energy arbitrage. You would earn some money from provision of resource. I don't know if you can participate in frequency restoration reserves and maybe provide some other products, and you try to separately put value on each of the use cases, and you sum it up, and that gives you the value of an asset. Not the average cost of energy.
Okay, thanks.
I see another hand raised from Ramon, please.
Yes, good afternoon, everyone. I would like to know about your idea about the role of the gas turbine in energy storage system, like a compressed air energy storage system. As you know, in the generation mode, this system consists of the gas turbine to operate, and I would like to know whether you focus on such a kind of the operation of the gas turbine as well or not.
I think compressed air with gas turbine is one of the solutions you can think of course, to balance and provide firm capacity, and that is I think one of the directions you can think of. And especially when you have this volatility of negative prices, you can charge the compressed air, and then during posted prices or high prices, you make use of it, and it will become much more profitable in the future than with the increase of electricity from renewables. And you might also think about if you can apply it at daily cycles in more sunny regions, then it's I think also very interesting to look at this, because then you might have the real time window of charging and discharging. But that's case by case. You have to look at in the local situation depending. But I think that is really interesting direction as well.
Yeah, this is exactly my point. I would like to know whether this daily operating regime will affect on the lifetime of the gas turbine or not, because it will be phased on the daily startup and shutdown, and whether it impacts on the life of the gas turbine or not.
Now, when you ramp down your turbine, there is some impact on your operating hours. So you it affects your maintenance schedule. So you have to do maintenance more frequently. Is that your question? How it affects?
I think you run out of you may be quicker at the sea inspection if you have typical gas turbine. But that has impact. And also there you might think about more robust ways of developing the gas turbine. But I didn't touch upon all that topic. Sorry.
It is. You need to look at the maintenance contract with gas turbines. So there is my first thought, I would think about maintenance schedule and cost of maintenance. But if you look at operation maintenance contract with your OEM, it typically says how many operating hours what's your operating hours window before you have to do inspection, and then how ramping, startup, shutdown, and ramping, how it affects your operating hours budget. And but that to me would be impact of flexible operation.
Yeah, thank you. And also, I have another question. What is generally the minimum allowable operating range of the gas turbine to meet the air pollutant regulations?
Yeah, that's really subject to supplier of the OEM of the gas turbine. NOx limit are most of the time a little bit the ones which you have to consider. And of course, I think, yeah, you see sometimes 25%, 30% of low load points where you're still within the NOx emissions domain. But certain suppliers can go deeper in part load because they have stage combustion, so you can avoid this NOx emissions increase. But that's really supply depending.
Yeah, and local, right? It's your permit. It's determined by your permit.
Yeah.
Thank you.
Yeah, sorry.
No, just I think
I think I was good.
Thank you. Yeah, good. Yeah, thank you.
What I was gonna say, I think physically gas turbine can operate from at low load points, but yeah, the NOx is what limits practically.
Yeah.
We still have okay, Milton.
Yeah, first, thank you for the first answer, and I think I'll use the microphone. It's just easier for my second one. As you said, in the future, we will have less and less operating hours, and there must be more income from flexibility, from providing resilience. But do we have also quantitative data of how this is shifting from the past to the present, and what are your predictions to the future? How fast this will change, and where are we now? I don't have a real gut feeling about this.
Yeah.
Yeah.
I think that is what we mentioned. So you need another way of evaluate the asset, and then maybe you don't do the marginal cost analysis, but you might do you go more to a spread analysis, market spreads, but market simulation. So that different, and then you look into, okay, this is the typical, let's say, portfolio of a certain country or area where I have my assets, and then you evaluate how you perform against your competing assets in this market. I think that will be much more of a more reliable, realistic evaluation of your asset. So you look at spread, the spreads you can make, the flexibility required, so you get more combination of certain analysis, and then you can evaluate whether your asset is can create this buildup of revenue streams as given by also by Ilya, that you have different markets. So you try to build up a case where you look at different markets. I have some grid support, you do some ancillary service, I will provide some power on imbalance market, and you build up your whole case, and then you have a certain uncertainties because imbalance market is not guaranteed at all. But at least you can look also with maximize, how do I compete against my competition? And then you can evaluate quickly. And there's a cost abatement curve, can also show what the actual cost is of the flexibility. So we will not be more looking only at marginal cost, but we look at the total cost, the storage cost as well. If you have a compressed air, or you have an electrolyzer hydrogen storage, and then hydrogen uses, or you import, or you have blue hydrogen import of whatever. But that's the whole system requires a different pricing mechanism and analysis, and that's, I think, what I try to say. So we need more tools for this. You cannot do it anymore with a only marginal base cost model. And then define future prices. While there is a demand side response, you get let's say intervention of demand side response or load shedding in your system. So you need to understand better the market where you're the local conditions, so to say, and how your asset will perform, and what kind of service you can offer. That's more or less what we try to.
Yeah. I would add, Martin, I would think about it differently. Like if I would be policymaker, I think the purpose of capacity remuneration mechanisms to cover your fixed costs. And I wouldn't think about it as like 60% of my revenue should come from energy market and 40% of my revenue should come from capacity market. I would think my fixed costs should be covered by capacity markets or long-term, I don't know, futures, and my variable cost, my running cost, should be covered by energy market. So that's how I would think about it, and not that certain percent should come from this market, certain percent should come from that market. And also, I think that's how policy, or let's say this is the economic theory, so that's probably how policymakers would think about it. And also where we stand about it, or let's say where we stand on this road. It's a good question. I don't have I don't have answer on top of my head, but I like this question, so I'll think about it.
Yeah, but still very insightful. Thank you very much.
Yeah. It's also when I was go ahead.
No, sorry.
It's just an anecdote from chemo times. We were also designing markets there, and that was assumption. Assumption behind capacity market was that it should cover your fixed costs. That's how markets were designed. So it's practical experience. It's not only economic theory.
Yeah, for sure. Thank you.
We'll have a few minutes for one or two last questions before we close the webinar.
I just have another question, yeah, René. So, what do you think? What will the decoupling of the gas price to the electricity price? What will it have of an impact into Europe? Do you know? Do you have an idea?
Yeah, well, that's subject to the country. If the country rely heavily on the spark spread, then it will have a significant impact. And if it is more nuclear based, then it has a less impact. So it's a little bit different from the Netherlands will have a significant impact, for instance, for sure. Yeah, and also countries like Germany, which heavily rely on development on gas. Also, if you decouple this, so that really is will have impact.
My question. Yeah. If you look now, we see that the less efficient turbine basically decides the price on the full electricity price, right? While we know that the price of the renewables is far lower. So the question becomes then: does the customer at the end see that difference? Yes or no?
Yeah, I think it is not a very transparent market. So, because you get curtailment everywhere in the North Sea. If there is wind, then everywhere, then we cannot take it in. So, for instance, on a number basis that we have, I think somewhere 40 gigawatt of solar panels, and then we get some 20 gigawatt of wind. But we only need at max peak capacity 20 gigawatts. So 60 gigawatt against 20 gigawatts. So we have by far too much. So we need to think about solutions where we can avoid curtailment. So we need to do something and take care of that. We also make use of all the electricity what can produce from renewables into the system, and then it will be on. If you do this, okay, it will reduce in total, if the amount of renewables is more, then to reduce the wholesale market price. But on the other side, you also get moments when there is nothing, and then this price will be higher. So you get less. I think you don't see the impact and less of gas, but of natural gas. But I think this will be much more driven by how much of this energy which is produced by renewables can be used during the moments when we need it by scarcity, And that will be a combined thing. But that's why you need market simulation tools for this. So you can do this time dependency. So
my other thought, if
Yeah.
let's say if like what you say, if renewables don't get enough revenue, if they're curtailed, then they would shift off market. They will try to secure more energy from power purchase agreements, etc. And then there is actually less volume traded on energy market.
Yeah.
And then actually it reinforces the price, like it reinforces the marginal. So the market becomes less liquid, but it actually maybe reinforces again the marginal principle.
Okay.
Yeah.
Thanks.
Right. So we do not see any further comments, questions, or raise hands. So we would like to close the webinar at this stage. And we'd like to thank again both Robert de Kler and Ilya Bilibin for their availability and presentation at today's webinar. And we hope you found it insightful. And so we'll still organize episodes for this seminar series in the next 2 months to come. And you will see the relevant information on the website of ETN Global, in particular also with reference to our upcoming annual and general meeting that is taking place in Malmö, Sweden. So with this, also conclude that we'll upload the recording of this webinar on our YouTube channel and also the presentation, the agreement of Robert and Ilya. Thank you again, and we wish you a good continuation of the week. Thank you.